Afternoon, and thank you everybody for joining us online where you are. So we're now a week on from the Chancellor's budget, the biggest tax raising budget, 26 billion tax raised, also one of the most leaked budgets, with even the OBR managing to leak the Chancellor's entire contents 50 minutes before she lifted her red box and started speaking. So now that we've been able to unpick all of that and some of the drama, I'm joined with an excellent panel across the board who are we're going to unpick it all for you and see where there's crumbs of optimism and some opportunities for business in there, if even the Chancellor didn't give many herself directly. So I'm joined by today Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, Oliver Lawson, Chief Financial Officer at Sigma Sports, Sacha Herrmann, Chief Financial Officer at Soldo, and my esteemed colleague, Chris Giles, economics commentator at the FT, of course, and who's been very much closely watching everything in the run-up and aftermath as well. So, but maybe if I could kick off with Karen, in terms of now we are a week there, we've had time to digest it all. What are your main takeaways? I mean, maybe we should go for the initial reaction, and now we've had time to digest a little bit what you made of it.
Thanks, Ashley, and good to see you all. Thanks for joining us. Let me start off with the bits where I'm perhaps a little disappointed, if not perhaps not surprised, but a little disappointed. And that's really just sitting back and reflecting on where we are, and just the fact that, this is a government with a fairly large majority, and we're at the beginning of a parliament. So this is really where I would like to see, as a macro forecaster, the tough stuff being taken on, the difficult decisions that need to be made, because of course, as we get closer to a general election, it's going to be much more crowd pleasing and politically orientated. And there is some tough stuff that does need to be tackled in the UK. We've been all focused on headroom and short-term balancing the books as we focused on the budget numbers. But actually, if we just step back and think slightly longer term, that's really where our fiscal problem lies. If we look at the forecast for government spending, for example, it's expected to rise from about 44% of GDP today to actually 60% of GDP within the next 50 years. And that's really because our population's aging. We've got many more people that are starting to taking money away from the Chancellor than there will be paying in. And so how we're going to get that spending bill under control, that intergenerational conversation, we're still just, nobody's willing to tackle that.
Tabloids have called it a budget for Benefit Street, of course, which was Kemi Badenoch, the Tory leader's kind of retort of, this isn't any sign that the public sector is getting any smaller. And we know where the growth typically, that sector doesn't really generate growth. It's the private sector it comes from, isn't it? And
so
there's not much there.
On getting spending under control, and as you say, if anything, they've expanded the generosity of the welfare state, where it's commendable. We do know there's a child poverty issue, but perhaps the conversation should have been about reprioritization. And it's really this long term. It's not just the welfare in terms of working age benefits. It is the fact our population's aging. On average, when you are in your working age, you pay the Chancellor £14,000 a year. And when you get into your 70s and onward, on average, you're taking from the Chancellor about £35,000 a year. So bear in mind how important those dynamics are. So disappointed, we're still not really having this conversation. And therefore, that to me, if we're not getting spending under control, it's just natural that we are going to be talking about what taxes over time are going to be going up to pay for this ever-growing spending bill. So that disappointed. Now let's maybe think about some things where we can be optimistic. The Chancellor did stick to her fiscal rules. The fiscal rules have been changed on average every 3 years, so she could have just come up with a whole new set.
I didn't realise it was that different. Yeah.
Yes, exactly. They don't have a great lifespan, our UK fiscal rules, so she did stick to them. She's also created herself a little bit in the short term of more of a buffer. So if we do get some bad news, this is this headroom thing that everybody keeps talking about. Maybe she won't be having to raise taxes imminently. She's already got a little bit She's
And this was the
borrowing.
golden number, wasn't it, Karen? Didn't from going from the wafer thin 9.9 to 21.7 billion, and that's what kind of markets initially were quite relieved about until they started unpicking it a little bit.
That's exactly right. But at least the thought, okay, we've at least got a little bit more in the kitty in case we do get some negative news. As you say, we could get into the details of how easily that can be eroded, but we're focusing on the positives for now. I'd say a couple of other things I liked were that, it was a very political budget in the end. She could have gone and increased the bank levy. It would have probably pleased the backbench, but she didn't. Recognition, she's already said, look, our financial services industry is important, and already pays more tax than lots of our competitors. Maybe I'm talking my own book there, but obviously that was good. I think the other thing that came through in the budget, though, that is worth giving them some credit for is the ISA reform. Now, it's not popular with everybody, but we do have a real problem here in the UK of we've actually amounted since the pandemic a massive savings pile. If we wanted to be really optimistic and talk about how we could get a massive revival in growth in the next year or so, it would be the fact that £1 trillion worth of savings has been accumulated, and about half of that is sat in cash. Now, that's not good for the economy because it's not being spent, but actually it's not good for individuals when real interest rates are negative. So trying to encourage an investor culture, I think, is a really critical part of, the individuals getting a return on their hard-earned savings, but also trying to make sure that money reaches businesses and therefore actually gets deployed in investment and growth. So I really like seeing that ISA reform.
Yeah. No, I think that's an excellent overview. Thank you, Karen. We'll definitely come back. Now, Chris, if I turn to you now, I remember, so the day after the budget, we published a piece about how businesses were quite miffed about the fact that there weren't many growth incentives in this budget. And I think there was that disappointment because businesses and the country had been told it was the number one priority of this government when they were on the campaign trail, and growth seemed, even the mentions of growth had halved in this budget. But you very sternly told me earlier this week that actually we shouldn't be relying on budgets for growth at all, and maybe that we're all being far too optimistic and even looking for it. But with that dig aside, what was your take on the budget? Oh, Chris, you're on mute. There you go.
Just on that point about what generates growth, I think the country's got itself into a bit of an odd place because we seem to be just looking to mummy or daddy, which is the government, to generate growth. And actually growth comes from all of us, and it comes particularly from business. And so the idea that the budget is going to be the thing that turns around the economy of the UK in and of itself, for me, is rather strange. So as Karen said, one of the key things that would create growth in the very short term is a better mood in the country, a better mood which will make people more willing to spend some of the accumulated savings. So either, as Karen would like it to be done, as investments into the productive capacity of the UK, that would be fantastic, but even into consumption, because consumers are not spending in the UK, and this is internationally unusual at the moment. So it's not happening in Europe, it's not happening in the US, not even happening in Japan at the moment. So it is something odd about
and
how
famously a nation of shopkeepers and shoppers as well. So we're really at odds.
So we're all a little bit miserable at the moment, and so it's not entirely clear. There's a more of a mood thing as well as a reality, because real incomes are growing and have been. They're not forecast to grow massively for the rest of the decade, but they are higher in the short term, and spending hasn't happened. So there is scope to have a better outcome. So the positive story you can tell, which again is actually got nothing to do with the budget at all, is everyone feels a little bit happier, people spend a bit more, companies invest a bit more, and you have a little bit of a virtuous circle going on for the next part of the decade. And that doesn't solve Karen's absolutely correct problems of what are we going to do in the long term. Nothing was done in the budget, but it does mean that it isn't only a miserable next 5, 10, 15 years, whoever's in charge. And it is down to all of us, I think, to sometimes think, is life really as bad as it's sometimes depicted in other parts of the media? I would say that, because I don't think we are overly gloomy about the country. And it probably isn't, probably isn't. It isn't for lots of parts of the UK and lots of people in the UK. It's not that bad. We are a strong, dynamic economy still, have been. Doesn't matter which party's in power, and the budget isn't the thing that determines whether we have a successful economy or not. Clearly, government is important, and we want government to take really good decisions. They didn't do a lot for the supply side of the economy this time round. But even if they had, even if the OBI had said, oh, look, you've scored, we can score this and this and this, those scores are tiny. They're really, really small. And we shouldn't, again, expect these things just to come from government. It'll be much more about technology, investment, AI. All these things are the things that ultimately will make us richer as a society, more prosperous, and hopefully happier.
Yeah, I mean, without risking kind of erring on the gloomy side of things, Chris, but in terms of that kind of that lack of growth measuring, I mean, do you think that was ever going to come through? Maybe we were optimistic even looking for that. And then the second point I was also going to say, you know, a number of the commentary seemed to be, it wasn't as bad as feared, right? It didn't crash the markets in terms of the three audiences that she had to play to. It didn't crash the markets, didn't really annoy business in the face that, you know, the banks got off without a banking levy, the lawyers weren't hit by LLP charges, and generally in terms of, it played very well to her own politicians, you know, which were the devil within in terms of keeping them happy with the welfare spending. So it wasn't as bad as feared.
I mean, I think we also have to look at, when we say there's nothing for growth, that doesn't mean we'll have no growth. It just means that we can't say that this budget in and of itself has increased the potential capacity of the UK economy to grow. So forecasts have quite a lot of growth in them. I'm just looking at them now, 9.2% growth over the next 5 years. That is a better performance than the past 5 years. Past 5 years having COVID in it, obviously, and it's sort of similar to the early 2010s. It's not as good as pre-financial crisis. Clearly, it's about a percentage point lower than pre-financial crisis, but 1.5%. If we achieve that, and we achieve the fiscal tightening, so the lower borrowing and better public finances over the 5 years that's forecast. If we achieve the forecast, I think people will feel a lot better at the end of the decade than they are feeling right now. And in terms of who did it please, I think markets are really in quite a good spot. It's been enormously volatile in the media and in the public, and the polling is terrible. But if you look at some of the other audiences, as you say, financial markets basically got what they wanted. There's still definitively some skepticism about whether the budget, whether it will actually happen, but the numbers look fine. So if it happens, financial markets are happy. It puts Britain from a position of having towards the worst public finances in amongst advanced economies to way better than halfway up the table, nearly in the top quartile. So if that happens, we have then demonstrated we can tighten our public finances in ways that other similar countries, US, France, Germany's going in the opposite direction, Japan, are not demonstrating. And that would be a real success for Britain. So I think the questions are more, backbenchers, as you said, were fine, business, not too bad. It was only media and the
I'll get Ollie's view in a minute on business,
which where it went down really, really badly. And I don't want to say, so I think the big question about the budget, the big thing is that what the government now needs to do on the public finances, it's show not tell. You've got to show that what your forecasts are accurate, and they're not just going to be too optimistic again, because
we're back on the delivery issue, aren't we?
Is in line. All the things that happened this year mustn't happen again.
Yeah, this is very true. Thanks, that great overview and crumbs of hope. So, but yeah, Sacha, maybe bring you in as somebody who might have a view of whether we're all, as Brits, being far too gloomy about things. But in terms of those pockets of actually, you know, things aren't that bad, and actually, if things are unstable, people are only just prioritizing different types of spending. And so, I just wanted to kind of think about. Hear your thoughts really on those things of, you know, maybe things aren't bad, we're just doing things differently.
Yeah, they are not in reality, and I think Yeah, Jill refers to investing and spending. We publish yearly a spend index over 25,000 customers, businesses, right, across UK and Europe, and we basically look at how they spend their money, right? And I think businesses got the message even before this budget, because what we have seen is they all fight for efficiency, right? So the investments now are spiking on investment lines like productivity-focused AI platform, for instance. So year on year, we have seen investments across our 25,000 businesses that are our customers. We have seen the spend increasing by 130%. Huge investment there. What we have seen as well is when it goes to software, 43% increase. And what's interesting there is not only companies invest in software, but they invest more than in the past in professional services. And the learning here is companies, I think, have got the message. It's not just about being efficient, but it needs to happen quickly, and they need to get ready for it. So they invest in professional services so that they have the faster return on their investments.
Yeah, I mean,
so I think from a spendings perspective, on a spendings perspective, we see things very positively. And the only thing where we see some savings and some reductions in reality are, I would say, lower added value type of activities. That is true that CFO tend to discontinue to the benefit of more return on investment capable type of spendings.
Yeah. Okay. No, that's interesting. I mean, Ollie, maybe having the real world example in terms of kind of the business reaction to it all, not as bad as feared, or actually kind of some lurking bombs that you didn't expect, or kind of how are you a week on?
I mean, it's certainly no lurking bottom wheel for us. I mean, we're a cycling retailer for anyone that's not really familiar with Sigma. So there was some concern about what might happen to the cycle to work policy, which actually didn't come through in the end. But apart from that, no real surprises, because I think the way that this budget had been handled is that so much was known and baked into consumer sentiment and mindset beforehand for the 6 months that leaks and other bits and pieces have been discussed.
Yeah, Ollie, just on that, actually, I mean, you, as you say, you would have been quite vulnerable if there had been a cycle to work. It might have given some sentiment shift. So did you pause any decisions, or kind of, do halt, and was it a bit like, well, let's wait and see what the budget says? Because that's what we were hearing from businesses a lot.
Yeah, absolutely. I mean, if that's a large area of our sales, it goes through that process, because that's how people are set up, because bikes are expensive. I mean, I won't sort of try and sell any bikes on this call, but they are great for so many reasons, but they aren't cheap. So if there is an incentive to pay less through that process, that would impact us. I mean, we're a larger retailer, so actually my concerns were more for the independent bike shops across the country that are far more reliant on bike sales rather than parts, accessories, and clothing, which we sell an awful lot of.
Yes.
So they would have been very badly hit, and there would have been a knock-on impact of additional closure rates, and it's already a net closure rate across the sector as it is. Yeah. So that didn't come through, which was good. But on the whole, I think that what we definitely experienced was a lot of deferred purchasing because of the uncertainty around the budget and what's gone on, and that has been set in for a number of months now. So it's very easy to. I mean, we're reliant on discretionary income and people spending when they want to. It's not an essential purchase, anything that we sell, unfortunately. So it's very easy to defer, and that's what we have seen. So a lot of the conversations through the sales teams, either in our stores or online or wherever it is, has seen things pushed out into the future. So it's changed. It impacted us across that period from making clear decisions on certain things we'd want to action. So I'm glad the budget is out the way and some of the certainty has come that it's been done, but equally now there's a little bit more uncertainty around what might happen regarding leadership. But that's another point entirely, and what that might bring.
Another discussion for May, perhaps.
Exactly.
But yes, it does seem to leap Mondo. Just to say thank you to everybody watching. My screen is filling up with questions, so I'll be peppering them throughout. Some very particularly niche questions, I'd like to say, and some kind of more broader public policy aims. But we will definitely be kind of tackling them. But one thing that we really wanted to focus on was the area of opportunity that still arises despite, you could say, a trundling growth and not many levers or incentives. But one thing that we've all talked about is if staffing costs are going to be increasing, whether you look at the minimum wage increases and the knock-on effect of that, or whether you look at the Employment Rights Bill or last year's NICs, we know that the cost of employing people is going to be going up. And so in terms of that workforce shift, what are we expecting, Chris? I mean, and obviously you layer that on top of the rise of AI and what can happen there. So maybe, Chris, if we just unpick that, and then I'll bring in Sacha.
Yeah, so in the short term, I think we are probably expecting unemployment to rise a little bit further. It's been creeping up. We have to be super careful when we're talking about the labour market because all the data is still completely messed up. It's improving.
It's dodgy data. Yeah,
it's improving, but the trends in the labour force survey, so the official employment numbers, are not the same as the trends in the measures that look at essentially at tax records or jobs. So the tax records are probably best for the trend, and those are in line with the unemployment statistics, are a little bit weak at the moment. Mm-hmm. Now, so the really big, interesting, difficult question for economists is the labour market weak because the government has put in place essentially damaging regulations in minimum wages and taxes in the form of employer and national insurance, that the sort of equilibrium level of unemployment is now higher. So we have to learn to live with a higher level of unemployment because you need a higher level to stop wages to get going not out of control, but just rising too fast for a stable rate of inflation. Or do we now have some more scope for the Bank of England essentially to loosen monetary policy so that companies can invest, households can spend a little bit more and bring that unemployment rate back down to where it was pre-COVID, roughly that sort of zone. And if it's the latter, then that's all well and good. And the Bank of England is going to be a little bit nervous about this. And this is where the splits on the Bank of England are. It's specifically about these sorts of issues, about what ultimately will be driving wages. The Office of Budget Responsibility was quite optimistic in the budget, so let's be clear about that. So they think unemployment is going to rise a little bit more and then start to fall essentially next year, and that it will go back to where it was, and there isn't any permanent scarring because of the national insurance effect. I think that might be a touch on the optimistic side, but probably broadly in the right ballpark, or a reasonable assumption to make. But of course, we don't know, and we're going to be feeling our way through the next year ahead. We're looking at wages, looking at inflation, looking at other labour market stats to see exactly where this falls out, because it's one of these terrible things in economics is there isn't a stat where you can say this proves this theory. You just have to feel your way a bit, and that is one of the reasons why the Bank of England.
You would be a forecaster. Karen, do you want to jump in?
Can I give you some stats? I do think actually when you do start to plough through the stats, you do draw a bit of a conclusion. And so if we bear in mind, and again, such well-intentioned policy, but how sometimes it doesn't always work out in the way you want. So the national minimum wage for 18 to 20-year-olds, that youngest cohort, in the last 2 years, when we put this rise with the last one, is up 26%.
Yeah.
And if we look at the jobs that have been shed, because the economy, and again, uncertainty about the data, as Chris said, but the official data say that the economy has shed 180,000 jobs. The absolute vast majority of those are in retail and hospitality, where I would have thought, a lot of that those individuals on living wage are working. So I do think that is the danger of very well-intentioned policies, but they may not have the influence on living standards and deprivation perhaps that we would want to see, what their intention for, because the economy is just not working out in that way.
And what a lot of retail and hospitality, maybe Ollie, you've got thoughts saying, is a lot of the people in those jobs, politicians have never really cared about, because they always point to the high churn rates and they're not kind of seen as the jobs for life or the skilled jobs. But they're also essential as either getting people back into the workforce or training young people how to turn up to work every day. And you know, kind of they're often first jobs and first steps on career ladders. So they do serve a very important purpose, kind of more wider for the social side of things. I'm conscious that we can talk all day, but in terms of the layering on AI on all of this, because what one person had said to me is, if we have all of those costs and the threat of AI, Labour's employment rights bill, as it stood earlier, like a week ago before the budget, before there'd been amendments, there was these day one rights where somebody could have the unfair dismissal immediately, which most businesses thought was a jobs killer. That's now been put through as an amendment. So that risk has slightly been taken away, but you still have the threat of AI kind of and what it could do for the jobs market. Sacha, you had some thoughts about this, I think, as well?
Yeah, I did. Fortunately, we are at Soldo, we are a B2B software business, so we are fortunate we are not directly impacted by the minimum wage increases. However, our customers are, especially we have customers in retail and leisure and hospitality sector, so that they will be definitely have an impact or feel an impact of the minimum wage increase. And well, I think there is no magic, right? They either will push their incremental cost downstream, meaning to their own customers or to the end customer, or they will be able to absorb the higher cost that comes through the minimum wage increases. And absorbing cost is basically difficult, but it can definitely help here. But one thing that is visible now is that AI is important, but it's a journey, right? That there is no magic bullet. It's not that you can bring AI in the mix and you all of a sudden are more efficient and can absorb and be more cost conscious or whatsoever. So it's a journey. You have to start somewhere, and companies that have already started are well positioned. And as I said, there are a lot of companies across UK that are on this journey already. So they will have, or they will see the increase in minimum wages, and they will start to feel soon the impact of and the benefits of AI being helping to be more efficient. The companies that have not yet been on the AI journey, well, it's never too late, and it's time to get ready for it. To be efficient.
And would you say, Sacha, it's kind of looking at it almost as a productivity tool rather than just something that's going to get rid of a load of workers? Because that's not actually happening in a lot of cases. It's more about becoming more efficient, right?
Exactly. And well, there has been the whole discussions around AI killing jobs. Well, it will definitely transform a lot of jobs, for sure. And we have had this hype of, oh, if you don't use AI, you're done. Yeah, that's probably true, but that there is a learning curve with AI. AI starts with just basically generating some content, and then at the other end of the chain, it's about embedding AI feature and capability into the daily processes. And this is where the value sits really, because then it's embedded in the process and you can accelerate, and you can, with the same number of people, you can absorb the growth and you can deliver far more than before.
Yeah. Thanks, Sacha. Ollie, one for you, and actually I'm going to bring in a question from because I think it's a neat point. So Sagar, thank you for this one. And it's asking about, which parts of the population are most worried about losing from the workforce, which I think is one. But what specific measures in the budget actually tackle root causes such as long-term sickness, caring responsibilities, and low incentives to return to work? I don't think that the budget actually tackles that, but just looking at those things, long-term sickness, the responsibilities low incentives to return to work. There's a lot being asked of business these days to step up to be more than just a business, but to be kind of a carer for your employees. I mean, how do you juggle that as a business that has to make money but also be a responsible employer now?
Yeah, I mean, that is absolutely something that we face the challenge with. And as just being a good human being, you want to look after your workforce. And the difficulty is that they are in certain pockets within our business. They are on lower incomes naturally, and so there are real challenges out there. And you can see in the conversations we have around cost of living with some people, we do whatever we can, where we can, to help, which goes far beyond what the parameters of a job description might be or a contract. But it's hard, and often you do want to do more. But what we're doing is we're engaging now with organisations like the Retail Trust, which is a wonderful charity that supports retailers, as well as engaging with other, like, for example, certain insurance companies. They provide support networks and things that are value adds that we can provide to our employees. But ultimately, your hands are slightly tied, and it's hard for our line managers too when they have their teams going to them with problems. And they all want to help, but they don't quite know what they can do.
Yes.
But I think that's a very human reaction, actually. And so as long as there's an open dialogue, we will always do what we can and do the right thing. But it's not easy because we have limited resources. We are constrained. We are trying to battle the increases in minimum wage, and sort of 26% was mentioned earlier. That is a very real impact to us. And then if you put on top of that the national insurance changes that then came through from 13.8 to 15%, and then changing the bands from 9.1k down to 6, like these have had big instant impacts on our cost base. So we and this is also off the back of a very, very turbulent few years post-COVID. So retail, hospitality, leisure has been absolutely through the ringer.
And it's sometimes called that everyday economy because it's the thing that's tangible and people kind of, are in touch with on a daily basis. And so you see it kind of in real life often.
Yeah, no, we do. So it's tough. It's tough. But I think that empathy, the human element within our business is how we're tackling a lot of those challenges. And we do what we can, where we can, but we can't solve every problem. Just there may be will to do so.
If you did, you'd be running for Chancellor. But one other question that we've got, which I think is really fitting in today particularly, it comes from Derek about can we do anything to bring down electricity market prices? And Chris, we've spoken before about how the high, globally high energy prices that businesses faces is one of the biggest drags for kind of maybe growth. But thinking about that, he mentions exactly what we need. It's driven inflation and required the government to intervene with support from industrial and domestic customers. We've seen that during the crisis, but even now, the supercharger scheme, the re-announcements on support, and obviously today's news about the investment in modernising that's going to be put on bills. But what are your thoughts about that? Because it's a thing that comes up as a priority time and time again.
Well, I think there's two facts, before we start talking about what you could do. One is that energy affects all of us, businesses, households. Every company is affected in some form, and every household by energy costs. Second is the UK energy costs are very high internationally. So those two things matter, and it puts us in a difficult spot. What can you do? Well, you could just say, and some political parties on the Conservatives and Reform are saying, well, let's not do this green stuff anymore, because it would save money. There's no doubt it saves money in the short term because you don't need the investment in the grid that the renewable sector needs and absolutely is required. That I don't think takes you a little bit of a way in the short term. It doesn't really solve the big problems in the medium term. If the government is going to do something, it'll have to do more of what it did about taking some of the renewables obligations that we have off, particularly electricity bills. and put them onto general taxation. That doesn't mean that we don't pay them. We just pay them in a different form.
In a different way, yeah, exactly.
We do pay them, not in bills. And so what that's essentially doing next year, so there's going to be a small increase for the upgrading of the grid and the gas network supply, which was announced this morning. But there's also going to be a little bit of that happening. So in the spring of this year, we should see some falls in bills. It all depends on what happens to the wholesale prices as well, which at the moment are falling in gas and electricity, which is good news for the UK as an importer. And so that might mean that we actually see inflation coming down quite fast. I don't think that means a green light to the Bank of England cutting rates, because they'll say, oh, well, this is a sort of slightly artificial drop in inflation. But when we have inflation maybe in the summer of 2.4, 2.5, which is the OBR's forecast, way down from what it currently is, just under 4, then I think the UK will look a little bit of an outlier with rather higher interest rates than other countries. And the Bank of England might look a little bit, it's not so much what it does immediately, it's more about where it thinks interest rates might end up. Because at the moment, the UK looks as if interest rates are going to end up higher than the US, higher than Europe, obviously higher than Japan, and that's not an easy place for business to be in, and it's not entirely clear, unless we really have got a big inflation problem, why the UK needs higher interest rates than other places. So I'm sort of relatively hopeful that next year a range of effects, we started talking about energy, will mean that we slightly have a better business environment, not hugely better, but it might feel a little bit better this time next year.
Very good. Karen, there's also been another question, because you mentioned just about that discrepancy between what we're having with the youth and the elderly population in terms of the give and take. One person, DG, has said, and I think that it speaks to the lack of boldness, perhaps, in this budget, of why are we still protecting the triple lock? The triple lock seems to be quite a large factor on adding to the national debt, but nobody seems willing to tackle this. Why? And I think it's a point that comes time and time again. I mean, it was a commitment, but those commitments can be broken. Do you think it would be right to have another look at the triple lock?
The triple lock is grossly inequitable. I mean, just a reminder, what the triple lock does is it pensions rise by either inflation or average earnings, or 2.5. The best of them. So it's been ratcheting up. I mean, imagine then when we had a year where inflation popped 11%, and I certainly didn't get the 11% pay rise there. Not asking for sympathy for me, but I'm sure a lot of people felt that, but pensioners did. So it's sort of ratcheted up very rapidly over recent years. And if we're just in this more precarious environment where we might get these pops in inflation, that's going to continue to happen. And the cost of it means that a demographic problem is just compounded. So absolutely we should be talking about this. But actually, Ashley, I think it's got to be part of a bigger conversation where we say, let's just all talk about this sensibly. The money that's going out has to grow in line with the money that's coming in. So whether it is our benefit system, whether it is pensions, that has to grow in line with average earnings, those people who are earning their salary. And I think that, to me, is the way of managing this politically difficult conversation, which must happen. But just to say, let's all just think about this sensibly. Think about your grandkids, think about your neighbours. This isn't about, there's too much of a conversation about this is us versus the Chancellor. And as a nation, we've got to start having a conversation about me versus my dad and my granddad and my neighbour, and actually just creating a bit of equity in the whole sense. And I think the triple lock's got to happen within that as part of a delinking where it's just every outgoing rises in line with average earnings. To me, that seems fair, that seems sensible. I can't see why that is politically contentious.
Yeah, well, I'm sure you might have had those conversations at Treasury, so let's know how that goes on.
Right.
Yeah, but so I think that's it. One of the problems, and I'll flip back to the economy side of things again. But Sacha, a lot of in this budget, a lot of these issues, initiatives, even tax rises, if you look at the salary sacrifice, aren't going to be coming in for a number of years. You know, we've got 2027, 2028, 2029 for a lot of them. Business still has to crack on. It can't wait for these other things that, yes, they can prepare, but they still need to be staying afloat and growing, as you say. So what should business leaders be, you know, busying themselves with? And what would you say? I mean, investing in tech, presumably, but what else would you say?
Yeah, thank you for asking this. I'm working in the tech industry, right? So obviously, tech is what I believe in, and I think it's through technology that the efficiency gain will really be materialized. And as you said, the good news is there is a bit of time until the full effect of those changes will be will be visible. So companies have still room to be on the journey, or to accelerate, or to start dealing and onboarding some technology. But I'm truly convinced that we're gonna need to do more with less, because there is no other way out. We have to absorb and to be more efficient, and it's a nice thought, right? To think about all of our jobs and think about it in a way to say, oh, tomorrow I will be faster, I will deliver more with more or less the same thing. So I think we can even look at this through a lens that is not rosy, but optimistic and positive, I would say.
Yeah, well, yes, you kind of have to. You just have to do it, don't you? You can't wallow for too long and wish for nicer things. It's, without wishing to quote Rachel Reeves, you know, she has to kind of work with what she's got, not what she might want to have, right? So there is that. Turning to that matter, though, a lot of these tax rises, Chris, are backloaded, right? As we say, you know, a lot of these things are going to be happening later on, and as Karen mentioned in the opening remarks, you know, a lot of these policies and tax rises are meant to be coming in when potentially Labour's on the campaign trail again, running into an election. So how do clever people such as yourself and in the markets view the likelihood of these tax rises actually going through? Will she have, or will Labour, should we say, have political capital to push these through?
I think the tax rises will happen this time around, particularly the large ones. You've got to really just look at the really big ones. There's a whole bunch of little ones.
Fiscal drag, the kind of salary
fiscal drag, the freezing allowances for a further 3 years, which I'm not actually too worried about. I think the allowances got too large, so that people felt they weren't actually part of the economy and part of society, part of paying taxes, being part of living in a civilized society. So I'm not too worried about it. It's in lots of ways quite weird, because the amount of money they raise depends on the level of inflation, and it's not, so you can't plan precisely for it, but I think that will happen. I think secondly, we need to recognize that this budget, the tax increases were backloaded, but it's coming on the back of a whole bunch of other budgets from this government last year and from the previous governments, which had baked in tax rises over the next few years. So there is actually quite a gentle progression of tax rises, and that's why the deficit doesn't stay high and then fall in 2029. If it happens according to the forecast, the deficit goes down gradually, and it goes down essentially because tax rises are coming in year after year after year, and that's why also you have these figures which have been banded around, that average real household disposable income will only grow 0.3% per year, and that's odd when the economy is forecast to go at 1.5%, but that difference, a lot of that is coming that the government is going to be taking quite a lot of those income gains. And it's not to spend on other people or yourself or services, it's to borrow less. And that is really important, because that ultimately, when we think about what's gone up, you know, there's been all this talk about Benefit Street in the budget. What's happening to welfare costs? They're flat as a pancake, flat as a share of GDP, not rising at all. Certain disability and health benefits are rising very fast, but other benefits are falling. What's really rising fast? Debt interest costs, and that's why you want to get your borrowing down, and health spending. Health spending
Yeah.
is going up very fast indeed.
Yeah.
And so those are the two big things that are driving public spending up, driving the figures that Karen was talking about at the start. It's not welfare. And this is why sometimes you feel, hang on, this debate we're having in the country isn't actually what's going on. We should be talking about health. How do we get more productivity out of the NHS? Because that is what, if we could get back to the productivity levels in the NHS of 2019, we could spend quite a lot less and have a better health system.
And have more people in work, and
have more people in work. So those are the sorts of things that we need to be talking about. If we can't suddenly say we can't not pay the interest on the debt, but if we can get our economy looking healthier, getting inflation down, getting people more confident about the UK, then borrowing costs can come down from here a little bit, but not going back to the early 2010 levels. And that also can create some more room. But so where the danger is, so that's the good news. I'm trying to be positive. The bad news is at the end of this decade, where around the election time, I think the tax rises will come in, but also the government has been vastly over optimistic about how it can control public spending in those years. I don't think it's going to be able to do that, and I think it will spend more money on the health service again. And it will spend more money on voters that it wants to attract in the 2029 election.
Yeah.
So that's the vulnerability in the public finances. It's not that taxes won't come in, but spending will go even higher.
The clock is ticking away. But you mentioned getting healthy, and it feels like we need to get Britain a bit more match fit. But Ollie, given that you sell stuff to very healthy people who like to wear lycra and whiz around on bikes, what could we have seen from this budget to encourage a healthier public finances, or what would you have liked to see? We kind of feel like we have been quite optimistic, but what was missing that you would have wanted to see?
I mean, obviously, as a CFO of a business, you are looking at cash in versus cash out. So anything that sort of makes that balance better is helpful. But I think it's not just about the numbers. It's about the sentiment and the rhetoric that comes from Westminster, I think. And Chris has just talked about the disconnect between the benefit street comment and actually where the cash is going. We've heard a lot of doom and gloom about the state the economy's in, but actually the economy's not actually in that bad state. We are still talking about growth. It's not like we're talking about recession. It's not the growth necessarily everyone wants, but it is still growth. So let's not knock ourselves too much on this stuff. Household savings have gone up, as we know. So consumers have the capability to spend more, but they just don't have the propensity at the moment to do so. So I think it's all about trying to give people the confidence and security in feeling wealthier, in feeling confident in going out and actually engaging with products and services, hospitality experiences, and that takes a bit more time than just one thing that will be delivered in a single silver bullet in a budget. I think that it's actually, we need to look to our leaders in this country to generate that spirit. And actually start talking up prosperity rather than talking down to everything else to try and justify some of the changes they're bringing in. And that is a tone from the top. It's a cultural thing. And as a leader in a business, you need to motivate a workforce. They need to motivate the UK's workforce.
Yeah, actually, that's great. But like Sacha, just quickly in terms of what do you tell your troops as a CFO, and also what would you tell other business leaders to get them kind of match fit for the current state of business?
Yeah, thank you for asking. What I'm trying to bring across is optimism and engagement around using new tools, new technology, and new stuff, because I think it makes the job much more interesting when you can automate things. So I'm trying to motivate my team through let's try new tools. Let's see what we can learn and how we can improve our operations. And I think so far they enjoy it.
Yeah, we need to be a bit bolder in trying these newfangled technologies out and kind of realize that actually they're maybe not that new. And there was a line the other day of, it's not necessarily these technologies replacing jobs. It's going to be those people who can work with them, right? Like, so we all need to get a bit better at that, maybe. Thank you. It felt like it flew past. Hopefully it did to you all too. I thoroughly enjoyed it. So thank you to everybody listening, and thank you for all the questions. We didn't get through all of them. I have to say that we're not tax advisors, so we can't advise you on whether it's best to go to Jersey or not. I'm afraid, to whoever asked that question, but I think, you know, patriotic duty suggests we should stay here. So thank you. If I could say thank you to all of the panelists, Karen Ward from JP Morgan, Oliver Lawson from Sigma Sports, Sacha Herrmann from Soldo, and of course Chris Giles, economics commentator at the FT. I'm Ashley Armstrong, Chief UK Business Correspondent. So hopefully you'll keep reading us, and thank you everyone for your time.